Okay, so we're going to look at the analysis of the equity section of the balance sheet. There's a few ratios I want you to be familiar with, and just to know this, and probably you might see one or two of them on your exam. But in an analysis of equity, we use equity ratios to evaluate the company's profitability and long-term solvency. Okay, solvency just means sustainability, or the ability to sustain itself for future. We have three ratios: rate of return on common stock equity, we have a payout ratio, and we have a book value per share. Okay, so let's just look at that real quick. Marshalls Inc. had net income of $360,000, declared and paid preferred dividends of $54,000, and an average common stockholders' equity of $2.55 million. Okay, so when we do a rate of return on common stockholder equity, we take the net income, but we subtract the paid preferred dividends out of there. And the reason why we would subtract the preferred dividends out of there is because a preferred dividend is somewhat of an obligation. And so to correctly or conservatively record this, or record our rate of return, or determine our rate of return, I should say, we really want to reduce any potential liability from net income. If you think about it, when we said preferred dividends, they have a higher priority of receiving dividends than if common stockholders were. So if there was dividends being dispersed, preferred dividends or preferred stockholders have to receive their dividends before a common stockholder would. And so therefore, from conservative accounting approach, we look at that and say, well, that's somewhat of an obligation, and so therefore we want to reduce that out of net income. So we take the net income minus preferred dividends and divide that, notice, by the average common stockholders' equity. A lot of people get tripped up by this. They take the beginning balance or they take the ending balance. If it's the average, we take the beginning year and we add the ending year and then divide that by 2. Here it's given that it's the average common stockholders' equity of $2.55 million. But notice, you may see an exam question, hint, hint, that says beginning equity is X amount of dollars, ending is X amount of dollars. To create the average, we take beginning and ending, add it together, and divide by 2, and that gives us our average common stockholders' equity, which is our denominator in this illustration. Therefore, the ratio in this scenario is 12%. Okay. Then the next thing is our payout ratio. It's basically to be able to pay out a computation. We have cash dividends of $100,000 and net income of $500,000 and no preferred stock outstanding. Okay, so we just take the cash dividends divided by net income minus preferred dividends. That gives us a 20% scenario. And then the last is book value per share. We basically take our common stockholders' equity and divide that by the outstanding shares, and that gives us $10 per share. Now, the book value per share is the amount each share would receive if the company were to be liquidated on the basis of amounts reported on the balance sheet. One thing I always share whenever we talk about ratios, when it comes to companies and different ratios, is these numbers don't mean a whole lot. I mean, they mean something, but they don't mean a whole lot if there's nothing to compare to. Okay, so if I'm a steel company and I have a 20% payout ratio, that means nothing to me unless I know that maybe another steel company has a 50% payout ratio, or another company has a 10% payout ratio. So we use it for comparative purposes, and in this case, it says in the fourth quarter of 2014, 36% of the earnings of the S&P were distributed via dividends. Okay, so here we're at 20, and so it sort of fell in line, so to speak. But really, that's the whole idea: is how does it compare to other companies? Rate of return 12%. Well, that's great. Well, what does 12% mean in this type of company, in this type of industry? What if it's a technology company and the rate of return is at 22%, and this company, Marshalls Inc., is not doing well then? So we sort of compare it with ratios, and that's the value of looking at these ratios, is to look at a similar company in a comparable industry, and to really rate against each other. And so that, from an investor standpoint, it determines, well, what company is better valued, therefore, than others. So, okay.